Good morning, everybody, and thanks for joining us for our mid-year investment market review this morning on 11th of July 2024. I know you're all busy, and even though the weather's not nice today, you've got lots of things to do on a July morning. So I appreciate the time logging in this morning for our live webinar. Just for this morning, it's going to be about 45 minutes in total. I'm going to speak for the first half of the webinar, and I'm delighted to be joined by Peter Smith, Investment Director with AVIVA Investors. And we're going to discuss three themes, and we'll put the slides away. We'll show one slide per theme, but generally we'll have the slides down and it'll be an open conversation as much as possible between Peter and myself. As I always say, I would encourage you all very much to ask questions as we go. Your questions are anonymous. It's only myself or Peter as a panelist will see the questions, and we will try to answer the questions throughout the webinar or at the end. So this is really important to get as much dialogue and questions as possible. Obviously, if anything comes to mind after the webinar, you all have my number and details. Just give me a call and ask any questions that come to mind afterwards. So there is a Q&A button, so do ask questions as we go, as topics come up. This is recorded, as you've seen. You're not being recorded, but we will send the recording afterwards, which may be of interest if you want to watch back, or if you want to send on to any colleagues or family members. We'll also send on the slides after the webinar. So in terms of agenda, I'm going to discuss markets at a high level and give the overview of where we are at from a mid-year perspective. There are 6 asset classes, but I'll discuss the outlook for the 4 main asset classes, and I will touch on what the 6 are at the end of my speaking as well. I'll also talk about the headwinds and the tailwinds. So headwinds are the bear market outlook in terms of what are the negatives facing markets, and the tailwinds, what are the positives facing markets as we look into the second part of 2024. And then I'll bring in Peter Smith at about 20 past for 3 topics, 7 minutes each. So we'll do our best to stick to the 7-minute slots for each of the 3. The first one we speak about is politics and markets. So 2024 is very much a year of politics. As we all know, we had the UK election, we have US election, we've had the French elections ongoing. We'll obviously have the Irish election on later this year, or most likely early next year. Interest rates and inflation are extremely important to all of our clients here. Know from me speaking about this for the last couple of years, there's the single most important factor for bond markets, equity markets, everything, where the underlying inflation figure is and how interest rates are impacted by that, and therefore what the risk-free rate of return and the performance of asset classes is based on that interest rate environment. And finally, the Magnificent Seven and AI. Peter will speak about that and how the global market indices are very much disproportionately weighted towards 6 or 7 big technology companies in the US. He'll give some nice stats and conversations around that. Okay, so what are the headline market points? What are the snapshots you want to take away from your 10 a.m. webinar with Compass Private Wealth to the next person you speak to? What are the key takeaways, okay? So firstly, markets, okay? Equity markets are hovering around all-time highs at the moment, in particular in the US. So we are in that situation where Peter will speak about the Magnificent Seven, but the S&P 500, which is the top 500 companies in the US, is literally at all-time highs at the moment. Next, I suppose the key takeaway point would be interest rates and inflation. Now, what happens with interest rates, as you know, is when inflation increases, central banks increase interest rates because they want to, I suppose, reward savers and punish borrowers and speculators. That's how they cool an economy. So when the economy is overheated and inflation is high, central banks want to cool an economy. So it's a constant struggle for central bankers to maintain what they call price stability. All central banks want interest rates to be and inflation to be at about the 2.5% rate. And so obviously inflation as a result of COVID hangover, quantitative easing a dozen years ago, Russia, Ukraine, things like that, inflation ran away from us. And now looks like inflation is coming back under control. So we're seeing this future rate reduction strategy by central banks. And we'll discuss that. It's probably happening a bit slower than forecast at this point in time, but we'll get Peter's views on that also. Government bond yields are stubbornly high. I guess the anticipation was 6-12 months ago, the expectation was that inflation was coming down, interest rates would come down, and government bond yields would come down. That just hasn't happened as quickly as had been anticipated yet, okay? Remember, when bond yields fall, that means bond prices will increase. So the capital value of bonds will increase as yields fall. So, anybody who hasn't bought bonds 6-12 months ago hasn't really missed out because the same value is there. But there is some upside potential to bonds at the moment. We have a chart on currencies later on. There hasn't been too much happening in the last 6 months or so on currencies. And unfortunately, we are still plagued by two very serious crises, Israel-Palestine and Russia-Ukraine. And these are continuously a big concern for markets, and the constant concern, humanitarian concern more than anything else. Obviously, that's the primary thing here. But for the purpose of this webinar discussing investment markets, it is always going to be concerned, can these things escalate, and what would happen if things escalated quite aggressively? Just picture paints 1,000 words. Q2, the second quarter of the year, was quite benign for markets. I know it looks like there's more indices up than down here, but the top index here is the Asian markets. They bounced back quite well in the second quarter of 2024. The B here up just over 4% in the US stock market. And again, that's generally driven by the main tech stocks in the US. If we look down the bottom here, E and F, these are the main European stock market indices. We've actually used to show the ISEC, the Euronext Ireland Stock Exchange, for any clients who see our market updates and these webinars. We've actually taken that off this because it's really a small cap index at this stage. It's quite irrelevant to be showing how the Irish market has performed because we've lost so many of the bigger Irish companies to other exchanges. So really looking at these 6 here, and you'll see here E and F are the European markets, the German stock market, the DAX 30 and the Euro stocks top 50 were both actually negative in the second quarter of the year. So quite a neutral overall quarter for markets. This chart here is to show inflation, okay? And it's, I think, a really insightful chart because it shows what the monthly inflation rate is over the last 5 years. And we can see here, back throughout 2020, we were in a negative inflation environment, a disinflationary, deflationary environment. And a deflationary environment is very troublesome and worrisome for central banks and governments because Joe Bloggs will say, well, I was going to buy that car, but if it's falling in price because I'm reading in the Central Statistics Office data that sees that the price of goods and services are falling, so why would I invest in that computer or the house refurb or the car or whatever it is if prices are falling? So what happens is that an economy can kind of freeze and shrivel up because everyone's expecting price to fall, so they defer spending, and that's very negative for markets. So the central banks wanted to get us out of that deflationary environment, okay? And by having so much capital available through quantitative easing and different measures, we saw inflation get very aggressive. In some economies it got to over 10%. In Ireland, it nearly hit 10%. So throughout 2022, it was very, very worrying where inflation was going. But, we can give out all we want about there's some Euro skeptics and some people have issues with the euro and being in the Eurozone. but like it did work in this instance by all the countries within the euro and the ECB ultimately reducing interest rates, increasing interest rate quite significantly and putting these measures in place. It did actually bring down inflation. And now it looks like the current trajectory has worked. What I would say is that we still have to be mindful of disinflation, deflation. Peter, I know you're listening, and something you might touch on, that at the moment, any concerns of deflation or disinflation are gone because people are of the view that inflation is sorted. But if the central banks don't sort out the interest rate policy at the right equilibrium, we could find that inflation will continue to fall, which is disinflation. Disinflation is falling inflation, but deflation is where things start falling on a monthly basis. So I think that is potentially a risk later this year or in 2025. We just have to wait and see. A key point, just to make people look at the perspective, okay? Inflation really started, call it just over 3 years ago. The start of 2022 ultimately is when inflation started ramping up significantly. Started 2021, I mean, sorry. So in just over 3 years, call it 40 months, 40 months. In that period, okay, inflation may come back down on an annual run rate or monthly run rate, but prices ultimately will probably end up being around 30% higher than they were. And that's kind of locked in. You can't, unless we get deflation, which is not what we want. So all else being equal, according to the average basket of goods and services as measured by the CSO, what cost somebody €100 or 100,000 euros 40 months ago, just over 3 years ago, is up on average about 30% now. So for all of our clients, when you're factoring your cash flow planning and your outgoings and that type of thing, just remember, like, what we have had is a period, probably turn out to be about 3.5 years, where prices will have increased by almost a third across the board. And that's unfortunately locked in. So think of pint of Guinness or the trip to Smith's Toys for the grandkids or the kids or whatever it is. Those prices aren't going to come back down. They're kind of locked in because commercial realities take over also. So it's just a point with inflation a lot of people forget about. And the two main, I suppose, bond markets that global markets watch are the US 10-year and the German 10-year. They're like the bellwethers or the benchmarks. And you'll see here, as I mentioned earlier on, these haven't really come down as quickly as the bond yields haven't come down. If you look over to the left of the chart, in particular in Germany on the right chart, like these 10-year yields were actually negative for a while. It's quite crazy to think that it's not that long ago where you'd have had to pay the German government a yield ultimately to keep your money to buy a German government bond. Whereas now, I suppose, the available rates are more attractive and they haven't come down. The yields haven't come down yet to what the market had anticipated. So hopefully you find these useful. And I think when I send all the slides afterwards, you can zoom in on these and see the text a bit better, and it'll give you a greater insight into what's happened with the bond markets. Currencies here, again, if we look at the last 6 months or so, the euro and the dollar, which are the sterling and the dollar, which are the two main currencies that Irish people consider. They haven't done too much recently, but it is worth looking back over the last 5 years. And these charts are quite insightful just to see the difference. As you know, if the dollar or the sterling strengthen relative to the euro, so if the dollar goes from 108 to $1 versus the euro, or if sterling goes from, say, 85 to 80, if you have non-euro assets listed in the US or listed in the UK, those will appreciate relative to the euros. Now, most people, the only sterling exposure they actually have is probably sterling UK property, physical property in the UK. The UK stock market is like less than 10% of the global market. So most people's concentration in the UK isn't actually that high. It's the US, the US accounts for around 60% of global stock markets. And if you want to have a diversified portfolio, you can't say, I don't want to take on dollar risk, I just want Eurozone risk. Then you're constricted to Germany, France, Italy, European Euro stocks type companies. So you have to take on global market exposure to have a diversified portfolio. And unfortunately, there's no way of avoiding currency risk. There is ways you can hedge currencies, but that's actually very, very expensive and cumbersome. So look, I just want to have a quick slide on the four main asset classes. Cash, deposit rates have increased. I always think people should have some element of cash in their portfolio, and there's no point in paying an investment manager fees to have them sit, have money on a current account earning no interest, charging fees on it. So we always think that putting money on term deposit is very worthwhile, and getting up to 3% would be the current deposit rate in Ireland at the moment. You obviously don't want to have all your money in cash because you lose purchasing power over the years, but cash has increased, deposit rates have increased significantly, and they've actually kind of surprised me by remaining relatively high throughout 2024. Bonds have become an investable asset class again. Yields have become more attractive on both government and corporate bond yields. There is an expression, it's called TINA, there is no alternative, and that's what the equity fund managers were selling a couple of years ago. They were saying there is no alternative to equities, because cash was negative, bonds were negative. Thankfully, the TINA thing has gone away now. There are alternatives. Cash yields are better, bond yields are better. Equities, like you have to have equities in the portfolio. Yes, you are buying it now at all-time highs, but I guess if you have a long-term strategy in place, will equities be higher than where they are now in 20 years' time? Certainly they will be. Will they be volatile on a 6, 12, 24-month basis? Absolutely. But equities, there is still good value there for diversified equity exposure. But don't put all your money into half dozen of the top tech companies in the US and expect to achieve a return. That's significantly riskier than having a more prudent, diversified strategy. Property has become, frankly, a more difficult asset class for Irish investors. 25, 30 years ago, you could walk down Bagot Street here in Dublin, or the South Mall in Cork, where I'm from, or O'Connell Street in Limerick, or wherever it may be, and people could come up with investment decisions on bricks and mortar property based on opportunities in the market and weaknesses here and there. That's all gone. It's become an institutional, regulated asset class. It's more expensive to manage, more expensive to buy. It's very difficult for retail investors to be dabbling in property these days. So really, the most efficient way to do it is either ignore it as an asset class or invest through a listed structure. Just, quick one page here on the risk profile of different asset classes. You've seen this before in any of our previous presentations. And again, just a real high level summary. What are the 6 main asset classes? First 4 is what I discussed on the previous slide. But private equity and alternatives are for business owners and entrepreneurs. There are other asset classes that come into the mix. I'm of the view of simplifying investment choices. There are only 6 places capital can be parked. You need to really simplify it and dumb it down. And these are the main asset classes. And all my job and our job in Compass Private Wealth is to advise clients as to what the most appropriate mix is. We're looking at these things every single day. It's easy for us, frankly, once the capital budget is set. I find it very straightforward and easy. I could do it in my sleep, how to populate an equity portfolio or a bond portfolio if the budget is there. The most important thing I always say to all of our clients, and I think it's very important, is don't just jump into something because you see a brochure or I want to invest here or there. You have to think holistically and strategically first, and then drill down into your chosen asset classes. So, bull case just on the left here, what are the positives? Inflation remains low and interest rates begin to fall aggressively. That's going to be a positive if that happens. Second point here on the left, will we avoid a recession completely? There has been a couple of technical recessions, but if we avoid it completely, that'll be a positive. And as Peter will discuss, national elections and politics will be very important over the next 6 months or so. The bear case is that geopolitical issues escalate. Unfortunately, what's happening in Russia, Ukraine, and Israel, Palestine, if they escalate, that will be negative for markets. If we fall into a global recession, which is possible because we have had a fairly positive environment for quite some time. And finally, I suppose, sometimes oil can, become more expensive for random factors or non-expected factors separate to what we're discussing here today, such as something happening in the Middle East or, a bit of a strategy by certain of the oil producing companies. And if that gets over $100 a barrel and sustains there, that will bring back a level of inflation, which will reduce the chance of interest rate cuts. So at this stage, I'm going to invite in our esteemed guest, Peter Smith, who's going to just join us here. Peter, thanks very much. Yeah, I can hear you.
Perfect.
Thanks very much for joining us today. Do you want to just start by giving us a bit of an overview of yourself and your day job and what you see at the moment in the global economic and market picture?
Yeah, sure, Jonathan. So yeah, as you said, my name is Peter Smith. I'm an investment director here in AVIVA Investors. Specifically, my role kind of focuses on really responsibility for the assets that we manage on behalf of AVIVA in Ireland. So I do these sort of updates on markets, on the products that we have in the market, and then on the other side on sort of product strategy, launching new products, and also giving our views on current market conditions and the environment we're in. So hopefully, Jonathan, I can answer some of your questions today that you're gonna pose. It's always an interesting time in markets, no matter when we look at them. There's been so much going on recently. You mentioned, I think it's funny, you mentioned TINA, which is that there is no alternative. I think TINA turned into TARA, which was there are real alternatives. So the market always loves these acronyms and names for certain things. But yeah, it's been very interesting. I mean, we've seen, obviously, you mentioned markets have been pretty positive year to date. Across the board, when we look at equity markets in general, that global basket of stocks, year to date, they're up about 15%. So that's a really strong focus. Some of that has, as you mentioned, come specifically from that sort of AI revolution that we're seeing in those tech names, and we'll touch on that, I'm sure, later on. But so equities have done well, bonds not so well. As you mentioned, expectations were for interest rates to fall this year. Markets kind of call that wrong at the beginning of the year. The markets, thought that interest rates were going to fall significantly, and had planned for that at the beginning of the year. And there were sort of 6 or 7 cuts in the US is what they were sort of expecting. And that now has changed. And as you mentioned, interest rates haven't fallen to the extent first thought of. And right now, sort of markets are believing interest rates in the US may have 2 cuts this year in sort of September and December, but that's very much based on I suppose the technical aspects of what central banks see. So they're looking at, as you mentioned, inflation. They're looking at job numbers. They're looking basically at the economy to see whether they need to take their foot off that lever that sort of stops the growth or inflation that we've been seeing recently. So yeah, so lots happening in markets, which is always very interesting.
Yes, and I suppose the first theme we have is politics, and
yeah,
everybody's aware from the news what's happening with the various elections this year. So, you kindly shared this slide with us. Do you want to just talk a bit about what is happening and what impact the elections globally are going to have on people's lives and their investment portfolios throughout 2024?
Yeah, so I mean, beginning of this year, kind of this unprecedented year for 2024 was that I think the figure is 70 countries were having elections throughout the world. Half the world's population is going to be voting this year. So on this slide, you can see just the different countries that have gone to vote already this year. Obviously, there's kind of 3 main, or I'd nearly say 4 main areas. So we had recently the UK election, we've had the French election, we have the US election coming up in November. So those kind of 3 main areas that impact us and impact many investors. Obviously, the US makes up a large chunk of many people's portfolios, particularly on the equity side. So, I mean, what's happened so far this year? What do elections lead to? I think if we take the French election first of all as a case in point, it will cause uncertainty in markets. Markets don't like uncertainty. And we can see that in what's happened to the French stock market since Macron announced the election back on I think it was the 9th of June. The French market has fallen about 6 or 7%. And that's relative to a global market, which is up about 4 or 5% in the same time frame. So we can see short term, we can see, uncertainty does impact on markets, but in the longer term these things tend to even out, to be honest with you. So I mean, when we look at what's happening in the UK election, I mean, it was pretty well flagged that Labour were going to win that. I think the UK is going to benefit from having sort of more stability. Labour are kind of ring fenced in on a budgetary point of view, so they don't have much room to wriggle on a budgetary point of view. So from that perspective, we don't think it's going to have a massive impact on changes to the current economic conditions in the UK, which are, when viewed against Europe and against the US, are a little tighter. I mean, if we're going to see a central bank, next central bank possibly reduce rates, we kind of think that will be the Bank of England, to be really honest. From the French election point of view, we've seen uncertainty. We've seen markets fall as a result. But I think what happened over the weekend, where we got, from the first round of elections, which were very much focused on the right wing of French politics and Marine Le Pen, we now have the other side. So the left wing ended up, the Left Alliance obviously got the majority of votes in last weekend's election. And in a way that muddies the water. And from a market's perspective, they see that as a better outcome than having, I suppose, the votes or majority going to a right or a left wing party because of the type of policies that they will bring along. A left leaning government is obviously going to have increased government spending. France is the last nation that needs to have that, to be honest with you, from running budget deficits. Obviously, on the right side of politics, Marine Le Pen is going to have very different views on Europe, very different views on immigration, very different views on how they support Ukraine against Russia. So, from a market perspective, markets actually like it more when I suppose the waters are muddied to an extent, that we don't have an outright winner. And that kind of leads to the last point I'm going to make on US. Obviously, when we look at the polls at the moment, Trump's leading by about 2%. So, and we can make up our own minds on the last presidential debate. But again, what the markets will like is if you get a split between the Senate and the House, so no one has overall majority on getting decisions through both houses, and there is that sort of equilibrium, which markets prefer, rather than Trump having an outright majority across both houses, being able to do whatever he wants. So I think markets will prefer if there's a split between the two houses, and that's what's happened in the past. You could argue, again, it doesn't help a specific party get through the policies that they want to implement, but in many ways, with that more, I suppose, with party politics now at either ends of the spectrum, markets feel that's a good thing. So I mean, yeah, it's been a very busy time from an election point of view. We've seen elections across the board, and we can talk about Taiwan elections happened earlier this year and the impact they'll have on China relations. But we could talk about this. It's a topic you could talk about for another hour, to be honest with you.
And yeah, thanks for that. And I suppose another very important theme at the moment is what I touched on earlier, where interest rates are relative to what happened with inflation. And we kind of got to this stage where central banks were all at, all-time highs in terms of what the interest rate policy was. And now we've got this expectation that interest rates will reduce. So can you just speak firstly about what's happened, the relevance for equity markets, for bond markets, and what we can expect throughout the remainder of this year and into 2025?
Yeah, so I mean, we kind of need to go back a little bit in time and think about during COVID, we had massive fiscal spends, government support, and the outcome of that was high inflation, which we hadn't seen for a decade or more. And to combat that inflation, as you said, governments or central banks around the world needed to increase interest rates. And that's a way of, as you mentioned before, it's a way of central banks trying to, I suppose, stymie growth in a way. So that's what they're trying to do with interest rates, is as inflation rises, let's tighten up on our monetary conditions so that people aren't spending as much. And as a result, it has a negative impact on economic growth, but will bring down inflation. So, central banks are having to juggle these two things. And you mentioned in your sort of bull bear outcomes is, there is that worry that if you leave interest rates too high for too long, you'll have this recessionary impact. And that's nearly last year, markets were anticipating this recessionary impact from government or from central banks running high interest rates, and that never happened. So we had resiliency in specifically in the US economy to a great extent, where they were able to withstand much higher interest rates, which was really interesting. So markets were expecting a recession, didn't really happen. Resiliency both from householder income, from wage growth, from unemployment numbers in the US, all remaining pretty strong. So from what we thought we would have was higher interest rates lead to cutting growth, which has an impact on causes a recession, hasn't happened. But as you mentioned, interest rates are, I kind of often think about central banks trying to manage interest rates and trying not to cause a recessionary impact on that. Is, if you think about it, it's like trying to steer an oil tanker into a really small harbor. It's a pretty blunt tool, to be honest with you. So from that point of view, where we are now is actually how it's been managed. It seems to have worked out quite well. We have inflation, which has been a little stickier since the beginning of the year than markets would like. So inflation sticking up around sort of 3% in the US, 3.1%. There's CPI numbers out in the US today. Market expects inflation to be around 3.1, 3.2% in the US. Does that give enough of a push to the Fed to cut interest rates in the US for the first time? Possibly not, but there's better soundings, and the market's expecting 2 interest rate cuts. So when I say 2 interest rate cuts, those are 25 basis point cuts each. So the market is expecting interest rate cuts coming in further into the year in the US. We've seen one cut by the ECB in June. Expect possibly one more left this year, but certainly expectations have changed from the beginning of the year to now, that actually, inflation's a little stickier. Central banks still need to keep interest rates higher than they first thought. And the impact on that is what we're seeing, sort of bond yields not falling to the extent that we possibly thought would happen at the beginning of the year.
Thanks, Peter. And, I suppose specific in relation to equities,
yeah,
we touched on, you mentioned, I mentioned that the US market is over 60% of global markets. And then within the US S&P 500, there's about half dozen, 6 or 7 big tech companies that are disproportionately weighted within that index. So, and the theme with these is technology and AI. So if you could just speak a bit about that theme and what the relevance is for investors.
Yeah, sure. Okay, so let's start off on this slide that you're showing here. So this is about looking at megatech companies in the S&P 500. S&P 500 is the main US stock market that people look at. Top 500 companies by market capitalization, weighted to the highest companies have the highest weighting in this index. So you can see here, if we look at the largest names in this index, so the 6 largest names in this index, Microsoft, Apple, Nvidia, Alphabet, which is Google, Amazon, and Meta, make up nearly 30% of that index. So you have 6 names making up 30% of the index. There's another 494 to make up the other part of that. And what's interesting is, when we talk about the returns, we look at Q2 2024, the S&P as an index, so the whole 500 companies, S&P 500 was up 4.3% in US dollars. The S&P, the 6 largest stocks, so those 6 largest stocks listed on this slide, were up 4.8%. And what's astounding, like it's incredible, the other 494 names actually fell in quarter 2 2024. So it really has been a tale of two halves. The AI, sort of this AI revolution, is very much focused on a few names which have done incredibly well year to date. So these 6 names are up about 50% year to date, but the rest of the market hasn't really been performing. It's kind of flat, to be honest with you. So it's just something that is quite extraordinary. What we call this is concentration risk in this index, and this is the same from a global extent. If you have a global basket of stocks of 600 names, you have the top names in this are these 6 companies, and they've been driving returns this year. So it's important that people realize that it's not a broad market. The broad market isn't moving higher. It is being led by a few very large tech names, which have been driven by this AI revolution. And I should say there is backing to this. So people talk about a bubble, and yes, valuations are very, very sort of high on these companies at the moment. But when we look back to the tech bubble back in 2000s, it wasn't based on very much. Whereas this time, the likes of NVIDIA, Microsoft, we're seeing earnings growth. NVIDIA grew its earnings last quarter year on year by 262%. So there's actually there's the reason we're seeing these names increase in share price so well is on the back of very strong earnings. The issue that we have is it's very concentrated to these stocks, and that's a slight worry for the market. But I mean, AI is really interesting. We all have seen its implications in various different parts of the business. I think for me, the question is, how long does it take? Obviously, we see it for the hardware companies like NVIDIA and their chips being used in data centers, and that's what's been driving it. But it's how long does AI take to actually have a productivity uplift in the general economy? And how long does it take for other companies to benefit from it? I mean, we go back to, the invention of the PC back in the 1970s. It took pretty much 25 years to see that productivity gain back at the beginning of the 2000s. If we look at cloud computing, it took about 12 years for that to have an actual impact on productivity. Smartphones took about 5 years. So there is this lag. So the issue we have here is, how long before the rest of the market can benefit from AI? And that's a very difficult subject, or it's a very difficult to call that, to be honest with you. So, time will tell. The next impact will be possibly on software companies. How do they monetize that? How do the likes of Adobe and Microsoft monetize that? And then it'll move into possibly healthcare. How does healthcare monetize AI and that kind of thing? So I think it's really broad. No one has the answers to this. I would say a lot of the increases in share price we've seen of those large tech names, there is substance behind the reasons we're seeing those rise. But that said, we've seen them rise extraordinarily high, and it is looking pretty tight at the top of the market at the moment. So yeah, there are concerns about that concentration risk.
Yeah, thanks for that, Peter. And there's a couple of questions that have come in, but please do ask questions because we've got 5 or 6 minutes left. Just one question, I suppose. I'm trying to think of something that encapsulates all 3 of your themes, Peter. But if you look at those US tech companies, those half dozen you mentioned there, and you factor in the US election and potentially a more protectionist strategy by Trump, with which may affect obviously chip makers like NVIDIA or Microsoft or whatever it is, and obviously Tesla, which isn't in those 6, but is in the 7. And if we also factor in a changing interest rate environment where interest rates are reducing, how do you see the composition? Because if we look at the S&P 500 20 years ago, 30 years ago, there's companies that we almost forgot existed back then. And same with the FTSE 100, same with all the indexes. I'm always trying to teach my investor or educate my clients to think it's all about thinking long term. Looking a lot of what we discussed today is in the short term, and I'm discussing market volatility and that type of thing. 10, 15 years time, how do you think these themes will play out? You know, if we do go into a Republican government and there is a protectionist, and Trump is saying, you know, China, to hell with you guys, there's tariffs, there's all this, and we move away from an open global economy, and maybe we double down on AI, or that falls away, and interest rates maybe go lower then again for longer. So if you could speak about that for a minute or two.
Yeah, sure. So I don't have a crystal ball is my first answer to that, Jonathan. But no, my other answer to that is I think for investors, this is why it's so important for them to have a fully diversified portfolio. And, you know, a lot of the products they will use have a pretty broad-based diversified allocation to lots of different stocks in a portfolio. And the reason for that is, you mentioned, you know, go back decades. And I mean, each decade you pretty much have that top 10 is evolving the whole time. So you go back to the 1980s and the top 10 stocks in the index were pretty much all oil companies. Go back to 10 years on from that to sort of 1990, 8 of the top 10 names were Japanese stocks. Now there's one Japanese stock in the top 50, which is Toyota. So my point with this is you see this evolution of the market. What many investors, as you mentioned, what we're talking about now, or what we've given the update on, short-term noise, lots of stuff going on, very difficult to call that right all the time. And I think for me, it's just important for people to have a diversified portfolio that, I suppose, takes part in markets when they evolve. Like somebody who owns a large basket of global stocks at the moment is doing well because AI is doing well, and they're seeing these increases in returns. That will evolve. I'm not going to try and second guess how or what that will look like in 5 years' time, but certainly, you know, those growth names that we've seen and have become far more apparent, those large tech names, it's hard to see a reason right now why they would in any way sort of fall off a cliff at the moment, given what we're seeing is that focus on AI. So I think that's going to be an ongoing focus over the next 5 years. But I think what you're saying about Trump and that protectionism, that deglobalization that we're seeing across the board, the onshoring of industries like building semiconductor chips back in the US, I think what that's led to is more fiscal spending. And I think that's going to lead to a point in time, which I'm slightly worried about, is governments have been borrowing money, you know, since COVID and before, to a massive extent. At some stage, we're going to have to. It's going to come to a head, to be honest with you. I mean, across the board, you can see that certainly fiscal spending is ongoing. There's going to have to be spending on I suppose the green economy as well, and getting emissions down. And generally, you know, some commentators are saying that's going to be 1% of GDP going forward. So I think my biggest worry is, you know, fiscal deficits and fiscal spending and the impact that's going to have. And at some point in the future, we're going to have to stop and take a really strong look at what's happening there.
Yeah, thanks, Peter. Just a couple of questions that have come in. One question I might just answer, it asks, you know, with all the risks out there in the market and globally, should you just cash in as a strategy? I suppose I'll briefly answer that. Like, at any point in time, I'm managing assets and wealth management for nearly 20 years now. There's always bull and bear factors. Okay, there's always reasons to be positive and negative. So at the moment, there's a lot of noise, a lot of negativity. But to be honest, that's kind of always the case. So there's always optimistic and negative. The issue is that if you went into cash now, some put all their assets into cash, okay, and markets fell for 3 months or 6 months or even 12 months, it'll prove to have been a positive, good decision to have cashed out. But depending on your age profile and your long-term objectives, you'd be very lucky if you were able to sell at a high and then buy in 20% lower. You know, you'd have made 20% then. Now, if someone said to me, and someone did say this recently to me, it was a charity, said, look, we have X amount of, I think we have X amount of capital, and they were introduced to Compass to invest it ultimately. But they said, but we have a project that's going to start in 18 months. We're going to need all the money then, so we can't risk losing it. So our advice was to not invest it because they have no capacity for loss or capacity for risk. So your investment risk should be correlated with your time horizon. And that's why compartmentalizing assets into different buckets is very important. So if you said, okay, I'm keeping this amount of capital aside, this is my safe money, then absolutely you shouldn't invest it, because that might be your 5 or 10-year bucket of cash flow deficit money. But if you then compartmentalize money within pensions or for the next generation or different long-term assets, then you have to accept risk in the short term, and understand that you may lose some quarters and some years, but overall, if you have a 10-year plus time horizon, the law of averages will work in your favor.
There's no a stat on that is in the last 100 years, there's no point in time that an investor would have lost money invested in equity markets over a 20-year rolling period. I mean, I spend a lot of time talking to people about this specific topic, Jonathan, and like my equities have produced a return, an annualized return for the last 30 years of pretty much 8% per annum. Yes, you're going to get ups and downs there. And as you say, it's around time horizon. But our view, a lot of the short-term stuff that we're talking about today is noise, and you should be sort of investing, setting a plan, looking forward for your time horizon. I can't make the point strong enough that trying to time the market doesn't work either. When do you go back in if you take money out? It's the hardest choice. You'll never get that right. But certainly from my perspective, we spend a lot of time talking about sort of that behavioral aspect of investing.
And last question, just before we finish up, a US-Euro trade war, if that did happen, which is very possible if Trump comes to power, how impactful would that be on markets in 2025?
So I think it could be. I mean, we're seeing it across the board. I mean, it's funny when I think about it. It's Europe getting caught in the crossfire between a US-China trade war as well, and the impact. I mean, Europe's just put in tariffs on Chinese EVs, so it's not just one way either. But I mean, obviously, what Trump is planning is worrying from a European perspective. I suppose Europe also has a very strong tie into China too, so that's can't be missed. So yeah, I mean, I think those aspects are worrying, but it's something that we're aware of in the shorter term. It's hard to call again. I mean, generally, what happens a lot of the time is, and we've seen this, and we even see this in France. And in Italy, have a right wing, a relatively right wing government in place. Is policies can dilute once people get into power, and it happened with Trump. I suppose Trump in his first stint to some extent, but yeah, it's a worry based, trade wars and tariffs and deglobalization. All of that is definitely something that we're seeing more of, and it's something that we sort of are keeping an eye on. It's hard to determine what will happen until after the impact of what we see comes out of Trump and if he gets into power. But certainly that would be a worry, and that whole global deglobalization is something that we're seeing more and more of. It'll lead to possibly higher inflation again. That's the impact that you have to think about is as things become more country specific, people are going to have to pay more for things and pay more for goods if they're not, if there isn't this sort of open economies, global economies, and that's the way we seem to be going.
Peter, on that, thank you so much for joining us today. That was very insightful. I hope all of our clients on the call enjoyed that and benefited from it. As I said, I'll send out the slides and the recordings later on today. So feel free to watch back. And if you have any questions on the content of it, again, reach out. Thanks again, Peter, and thanks to you all for attending.
Thank you.